You know, in the world of investing, there's this invisible line, a single day, that can make a massive difference in how much of your hard-earned profit you actually get to keep. Today, we're going to break down this crucial rule that every single investor, new or old, absolutely needs to understand.
Think about that for a second. An impatient tax. It's a pretty powerful concept, right? What if just waiting a couple more days, literally 48 hours, before selling that big winner could save you thousands of dollars? How is it possible that such a tiny window of time can have such a huge impact? Well, let's find out.
Okay, so to really see how this plays out, let's follow the story of two investors. We've got Sam the flipper and Pat the planner. Now, Sam is all about that instant gratification, you know? He's in it for the quick score. Pat, on the other hand, is playing the long game. She's got that grind set, focused on building real, lasting financial freedom.
All right, so here's the deal. Sam and Pat, they both see the same opportunity. Each of them puts $5,000 into a buzzy tech stock. And guess what? They absolutely nailed it. The stock doubles, turning their $5,000 into $10,000. So they're both sitting on a very nice $5,000 profit. They're starting from the exact same point.
But this is the moment. This is where everything changes. Sam, he sees that profit, gets excited, and cashes out on day 364, just shy of a full year. Pat, she's sticking to her plan. She waits just 2 more days and sells on day 366. Same investment, same profit, but a critically different decision based on a tiny 2-day window.
So, what do you think? Who actually walked away with more money in their pocket? I mean, it's just 2 days. How much of a difference could that possibly make?
And wow, the answer is, it is not even close. Just look at this chart. Pat the planner kept way more of her profit. That little 2-day wait made a huge difference. Sam the flipper, just by being a little too quick on the trigger, ended up handing over a much bigger chunk of his winnings to the IRS. So, what in the world is going on here?
So, here's what happened to Sam. He got hit with what's called a short-term capital gain. Because he sold that stock in under a year, the IRS looks at that profit and treats it exactly like his salary from his job. That means it gets taxed at his highest possible income tax rate. Ouch.
And Pat? Well, this is where that tiny little wait paid off big time. By holding the stock for more than 1 year, even by just a day, her profit qualified as a long-term capital gain. And this type of gain gets a special VIP pass to a much lower tax rate.
Honestly, the easiest way to think about this is like a loyalty discount from the IRS. It's like the tax system is basically giving you a reward for your patience, for believing in your investment for the long haul. You stick around for more than a year, you get a better deal. It's that simple.
Let's put some actual numbers to this, because this is where it gets crazy. Sam's short-term gain is taxed just like his income. That could be a rate anywhere from 24% all the way up to 37%. But Pat's long-term gain, that gets a special rate. It could be 15%, 20%, or for some people, even 0%. The difference in the final tax bill is just massive.
Okay, so this all makes sense on paper, right? But why? Why does the government even have this rule in the first place? Why would they intentionally set up a system that rewards you just for waiting a little bit longer?
Well, it actually gets down to what the government wants to see happen in the economy. It's all about fostering what you could call a stewardship mindset. They want to encourage people to make long-term investments in companies to help them grow over time. They'd rather reward that than reward rapid-fire, short-term trading that can sometimes make the markets a little shaky.
So what's the big takeaway for you? Here's a super simple thing you can do, like right now. Pull up your investment app, find something you own, and look for the date you bought it. Then open up your calendar and set a reminder for 1 year and 1 day after that purchase date. That little alert, that's your financial freedom reminder. That's the magic date when your potential profit flips from short-term to long-term.
And really, that's what this is all about. This isn't just some tax trick. It's a fundamental part of thinking strategically as an investor. So I'll leave you with this question. Now that you know about this critical 365-day line, how is that going to change the way you plan your next move in the market?